China's first quarter growth exceeded expectations. We partner now with the FT to bring you more. Lex on Bloomberg brings you a sneak peek at the Financial Times' flagship column a day early. Ben McLannahan joining us now from Hong Kong. Ben, always glad to check with you.
Good morning.
So, I mean, a blowout quarter, China's best first quarter in almost 3 years. What about the consumption part? And is anybody questioning the validity of the data?
Well, there's always questions about the validity of Chinese economic data. They're, in most cases, very justified. But if you look at the evidence that we have, which is the numbers that emerge from the National Bureau of Statistics, they're very good, as you say, in almost every respect. 11.9% year-on-year growth is much better than the 10% we saw in the fourth quarter. And the composition of growth, as you say, is much better. There's much greater emphasis on domestic consumption. For example, passenger autos were up about 75% year-on-year. And Mercedes-Benz, the Chinese branch of the German car maker, said it had doubled Chinese sales. So that part of the story is going very well. And better news in terms of fears over tightening was the fact that CPI inflation dropped from 2.7% in February to 2.4% in March, which doesn't suggest that China really needs to tighten anytime soon.
So you think that the Chinese government, then, the administration, is not going to be worried about inflation?
Well, on the basis of that pure CPI number, then there's no case, certainly, to start raising benchmark interest rates anytime soon. But underneath some of that data, there are more reasons to be fearful. The PPI, that's the factory gate prices, they're up about 5.5%, which is probably higher than they'd like, and they suggest incipient inflation pressures building for consumers. And also, more significantly, on the property side, of course, they don't feed into any of the established data series. But yesterday, there was data out from the NBS saying that prices were up 11.7% nationwide in 7 cities, which is the highest ever since records began back in 2006.
So let's talk about property then, Ben. I mean, it seems to be adding fuel to the fire that there is a property bubble.
That's right. Of course, you'll never hear the word bubble or overexuberance from policymakers. All you'll hear is pledges to rein in what they call excessive growth in prices. But this is excessive. Last time around, the cue was 10% year-on-year growth in property prices, and that was the cue to really clamp down on the supply side, developers restricting bank credit, and that caused the year-on-year data series to fall from about 10% to zero, and there was in fact negative readings for about 6 months. And so this time around, there's been little tinkering on the supply side, just a fair amount of tinkering on the demand side. For example, the deposits for home buyers have been raised today, and there's a little more restrictions. But serious action seems a long way away.
Ben, we thank you as always. Ben McLannahan joining us there from the FT from Hong Kong.